In today's video, I'm going to share 3 companies who just grew their dividend payment at a huge rate. Each is a high-quality dividend growth stock, potentially deserving a place in your portfolio. My name is Zach, this is Dividend Data, and you should leave a like and subscribe to the channel if you enjoyed the video. Throughout, I'll be using my stock research tool, which is available at dividenddata.com. Dividend raises are the best part of a dividend growth strategy. Stock number 1 that I will share today is one of my core holdings added at the start of 2023. Broadcom, ticker symbol AVGO, is one of the best dividend growth stocks you can buy. The company just reported earnings where they announced a 14.1% dividend increase. The new quarterly dividend is $5.25 per share, making the annual dividend $21. This is a continuation of Broadcom's strong history of growth. Excluding this recent increase, the dividend has a 5-year compound annual growth rate of 21.32%. This is sustainable with a 2022 annual free cash flow payout ratio of 43%. The growth of free cash flow fuels Broadcom's dividend growth and stock price appreciation. Broadcom's free cash flow per share has grown at a 24.06% 5-year compound annual growth rate. That is massive growth. So how does it happen? Well, Broadcom is primarily a fabless semiconductor company, which means they have very little capital expenditures as they outsource manufacturing to partners like TSMC. Additionally, they sell high-margin products with annual gross margins well over 68%. These factors make Broadcom a free cash flow machine. The company continues to make acquisitions and strategically invest in their business. The focus is always on optimizing cash generation. In fact, they just completed the acquisition of VMware, which adds to their growing suite of software offerings. I covered the details of this deal and the overall Broadcom business in my Broadcom stock review video. I made this in March 2023, around the time I bought my position. Since my Broadcom purchase, I am up 62%. I would say the stock now leans overvalued. Its valuation has gotten caught up in the semiconductor AI boom, of course led by Nvidia. However, Broadcom has not seen the massive surge that companies like Nvidia have. That makes sense since they are not in the same market. That said, Broadcom is a high-quality business that will grow well into the future. It makes a great long-term dividend growth stock. Stock number 2 is Deere & Company, ticker symbol DE. This is the industrial giant which sells farm and heavy construction machinery under the iconic John Deere brand. Surprising to some, Deere is a high-growth company which has delivered stellar shareholder returns. If you're a dividend growth investor, this needs to be on your watch list. Over the past 5 quarterly dividends, there have been 4 raises. These are not minor increases either. The most recent increase was 8.89%, which followed an 8% increase in the prior quarter. Deere's dividend is interesting because it does not follow a steady pattern. They will often go years with no increases, followed by sudden surges in growth. I assume this largely follows their business expansion, especially recently. The 3-year compound annual growth rate of the dividend is a massive 24.6%. This follows their recent surge in earnings. That means the Deere dividend has actually remained sustainable. In fact, the payout ratio based on net income has actually declined all the way to 14%. This means the 2023 annual net income exceeded the growth of dividends paid. However, payout ratio based on free cash flow tells a more sober story. The 2023 free cash flow payout ratio is 34%. This is still very strong, building from a weak 2022. Clearly, the John Deere management understands their business, and these dividends were backed up by business fundamentals. Since 2020, Deere has seen significant free cash flow growth. Based on the recent 2 quarters and the dividend increases, I'd expect 2024 to have record free cash flow. This allows them to buy back large amounts of shares in addition to dividend raises. With the recent 8.89% dividend increase, John Deere has an annual dividend of $5.88. At current prices, that gives the stock a 1.63% dividend yield. Overall, DE stock seems like a great fit for an investor with a dividend growth strategy. But why don't I own the stock? I really need to dive into exactly what in the business caused the earnings to surge so rapidly in 2020. Is this growth going to continue well into the future? Perhaps those are questions to answer in a future video. Comment below if you want to see a full John Deere stock review. Stock number 3 is Aflac, ticker symbol AFL. Aflac is one of the leading insurance companies with large operations in the US and Japan. The stock is a dividend aristocrat, meaning it has over 25 years of consecutive annual dividend growth. Aflac just recently announced a massive 19.05% dividend increase. This continues their long track record of growth. The 10-year compound annual growth rate rate of the dividend is 10.45%. This is sustainable too, with a payout ratio based on free cash flow of 25% in 2023. That leaves a lot of room for continued growth. With their large cash flows, Aflac buys back stock on a regular basis. This is significant, sometimes over 5% of their shares outstanding every year. Both of these have contributed to strong shareholder returns. With the dividend raise, Aflac pays an annual dividend of $2 per share. That is a 2.44% dividend yield at current prices. Aflac seems to still trade relatively cheap despite high growth. I believe the stock deserves a place on your watch list as a dividend growth investor. In fact, I'm adding it to mine. So those are 3 top dividend growth stocks who just had big raises. Please leave a like, share, and subscribe to the channel for more videos and stock analysis just like this. Sign up for dividenddata.com if you want to use the research tool I've been showing throughout. Here you can do deep financial analysis on over 7,500 stocks, helping you find better investments. If the software helps you identify just one slightly better stock, then it pays for itself. Here you also gain access to my portfolio tracker, which provides unique insights for the dividend-focused investor. Link in the description and pinned comment. Thanks for watching.